Good morning, everybody. How are you? I know I'm a new face. My name is Becky. I'm the new Director of Education and Events at PAMIC, so it's nice to meet you all. Most of my background is in early childhood education, so I'm normally in front of kids with a mic, so excuse me if I say, is everybody good? Thumbs up. Can I see everybody's thumbs up? Good. All right. A couple of things to note. First of all, just thank you guys so much for attending in person. Also, we are hybrid today, so thank you so much to everyone who is attending virtually. The attendance list, event materials, and recorded sessions will be available on our website after the conclusion of the seminar, so that will be available for you guys as a resource. We are providing CE credits. If you missed the sign-in sheet, you just need to sign in and sign out up front at the registration table. If you're online virtually, there will be polls that pop up through the seminar, so make sure you answer those as they come through. Also, we have hand sanitizer at every table, but if you need more or if you find yourself needing a mask, we have them out front at the registration table. I want to say thank you to all of our sponsors, our platinum sponsors, Baker Tilly, Donegal Insurance Group, Inquiron, Gen Re, HSB and Munich Re, Mutual Boiler Re, Pennsylvania Lumbermen's Mutual Insurance Company, Guy Carpenter and Willis Re. As well, our Flex Gold sponsor is Berkeley Re Solutions, and our Flex Bronze sponsors are Westmont and Associates, Tuscarora Wayne Group of Companies, and Optima SIU, and our bronze sponsors are Travelers Boiler Re and Mutual Inspection Bureau. If you guys pass the restrooms on your way in, so if you need to use the restroom, it's to rights and down the hallway and you'll see them. And again, thank you so much for attending. I'm going to go ahead and introduce our first speaker. Unfortunately, he had a flight situation and couldn't make it in person today, so he'll be presenting virtually for everyone. His name is Mike Strakhov from Live Oak Bank. Mike joined Live Oak Bank with more than 27 years in the insurance industry. He has held positions as a claim adjuster, commercial producer, personal and commercial lines marketing manager, territory manager, and the head of a large multi-state agency. Prior to Live Oak, Mike served as branch vice president of CNA Insurance Companies for the state of Ohio. His career also included tenure with Chubb Group of Insurance Companies, where he was a branch manager responsible for all aspects of management for the states of Alabama and Mississippi. He then moved to First Niagara Risk Management in various roles, including interim CEO and managing director of field operations of a 67 million plus revenue insurance broker consisting of 90 producers across New York, Pennsylvania, and Connecticut. As a member of the FNRM acquisition team, he participated in the review and analysis of a significant number of agency acquisitions. Mike has a master in insurance management from Boston University and a CPCU designation from the American Institute for Chartered Property Casualty Underwriters. Mike is head of insurance lending at Live Oak Bank. He's responsible for leading the insurance lending team in developing a profitable portfolio of insurance agency loans across the United States. So if you want to turn to the screen and have a listen to Mike.
Good morning, and thank you for the opportunity to be here. As previously referenced, American Airlines made my decision to be in Harrisburg for me. So my intent was to be there in person. But I think I should be able to get this all accomplished via my probably 4,000th Zoom call. So wanted to, obviously the topic today is keeping independent agents independent. And, you know, I'm going to make some assumptions based on this presentation. And there's really going to be two parts to the presentation. One, talk about the activity in the M&A space across the United States. And also talk about what my recommendations or suggestions that insurance companies can take or actions they can take in order to kind of help this kind of tidal wave of agency consolidation that's happening around the country. So some of the assumptions I've made, that at some point, everyone in this room is either heavily dependent or exclusively dependent on the independent agent distribution channel, that they're very important partners to what you do and how you get your business to the eventual end user, the customer, and relying on the independent agency system is a critical part of your business strategy. Another assumption is that everyone in the room probably knows at least one agency that has sold in the last few years. And sometimes that one agency or the agencies that you're aware of have been very critical to the distribution of your products in the marketplace. And usually when that happens, there's a couple things that come to mind or some thoughts that people have. The first one being, I didn't see that coming. And sometimes that's the fact that an agency sold, but also at times it could be who the agency sold to. But many times the insurance company finds out about an acquisition either right before, and when I say right before, that could really be the day before closing or shortly after, which really gives you, the insurance company really no time to react other than reactively versus being proactively and being part of the conversations well in advance. And then the second notion that comes to mind is, what does this mean? So if you have an agency that sold, what is going to be the impact for the insurance company kind of moving forward? Because you can be certain there will be some could be positive, some could be negative, but understanding where you are in that or what that impact will be to your particular company needs to be seen and will happen probably over time. But that's typically a first thought is, didn't see that coming. And second, what's that mean for you and your company? So with that, we'll jump right in. So the agenda for today, we're going to talk a little bit about the overview of insurance agency consolidation. So anyone that's been involved in the space, works with agents, has been keeping an eye on, whatever the headlines might be in the insurance space. Insurance agency consolidation is a headline issue. It's been something that's been, it's not new. There has been a trend over time, and we'll talk about that. Factors of driving activity and what factors will continue in the future to drive additional activity in the years to come. Impact to insurance distribution. And, as one might expect with the amount of consolidation that's going on, that does impact a lot of things. The number of overall agencies, representation in certain geographies, et cetera. So we'll unpack that a bit. And then education and resources. This is where the presentation is going to pivot a bit. And I'm going to start talking about things for insurance companies to consider as they work with their agency plan to maybe have a better pulse and maybe more proactive approach to working with their agents as they manage through a lot of different things. And then develop a plan. And again, kind of the second part of that pivot is kind of how can you be involved in the process. So one thing before I move on, we decided that we would wait till the end for Q&A. So more than happy to answer any questions along the way. So jot them down if you could. But just for the sake of flow, we're going to kind of wait to the end of the presentation in order to address those. So here, I'm going to quote a number of sources throughout this presentation. And one of the sources, and I'll reference it, is the 2020 Agency Universe study. That is a study that's sponsored by the Big I and Future One. And every 2 years they come through with the study. Obviously, they're not talking to every agency in the U.S., but it is a good representation of kind of the thoughts and what's happening within the industry. And one of the things that you'll see this slide here. It's a 24-year snapshot of really how many independent insurance agencies are in the U.S. And at their own admission, it's not 100% scientific and probably 100% accurate, but it is directionally accurate, and it's something that they've tried to improve over time in collecting this information. So I do feel confident that what we're looking at is a good representation of the total number of independent agencies, at least through this 24-year period. And as you can tell, and you see, the high watermark, 1996, there was 44,000 insurance agencies. And then in the last study they did to the far right, 2020, 36,000. So, over time, there has been a reduction. The one thing that I think is good news in this slide is that there's been a considerable amount of consolidation. And if you look at kind of 36,000, based on the headlines and what we're seeing and the activity that we see at Live Oak Bank, it has really been, pretty remarkable to see how resilient, this industry is from a distribution perspective. For every agency sold, I'm sure it's not one-to-one, but you do have people that are either startups, creating their own agencies, maybe spinning out of an agency that recently has been acquired. So the rate at that decline, it strikes me anyway, to be much less, significant than the amount of consolidation that you're seeing. So a lot of agency locations are, or new startups or new agency entities have been, I wouldn't say keeping pace, but certainly filling in some of the gaps on, where you see some of the acquisition activity. Another source I'm going to quote kind of throughout the presentation is from Optis Partners, and the next several slides will be slides that are from their quarterly report. So if you don't follow Optis Partners, Marshberry, Reagan and Associates, there's a number of folks out there, Sika Fletcher being another one, all report quarterly on the M&A activity for what they describe as announced deals. So you can follow kind of what's been happening over time, and this graph here is a good illustration, and we're going to kind of break this down a little further in the next few slides. But the first thing I think would be important is to define announced deals. So announced deals are ones that are transactions involving, large publicly traded agencies, private equity or private equity backed agencies, and then large private buyers. And then there might be others that kind of quote unquote announce their deals. And why are these deals announced? And we'll talk about the opposite of announced deals in a second. But many times, if you're publicly traded, you're required to release this information as part of your, disclosures, as a publicly traded company. So those are announced. Private equity announces their deals as well for a lot of reasons. One of them being kind of a promo, and the fact that, they're in the acquisition business. They want that to be known, and they do kind of report what they're doing in the acquisition space, pretty regularly. And then large private might do the same as well, just to make sure that people are aware that they are active in the space. And many times you have the same players that represent either buy or sell side, consultants, if you will, that will report, that they just closed this deal or that deal. So with all of that being said, there are a number of entities out there that will kind of tally these results and come up with kind of year-end announced deals numbers. So it begs the question, what's kind of the opposite of announced deals? I'm going to be crafty and creative and call them unannounced deals. But really, these are the deals that happen between two private agencies. So privately held, in any town, USA. I want to sell my agency. I'm going to sell it to, Bob across town, or, Jim across county, or whoever it might be. But it doesn't involve a large public, private equity backed, or a large private firm that announces their deals. There's really no, reason for these folks to make it public unless they share it. And it might make the news locally, but it doesn't necessarily get picked up on, from a national basis. So net result is there is no, entity out there that kind of aggregates these unannounced deals on any basis. But this is a good proxy for, the activity of what we're seeing, where Live Oak Bank plays in the space. We don't lend to Hub or AgriSure or Assured Partners or any of the more well-known, kind of private equity backed, large consolidator of agencies. We're more funding those private, deals. So that's the, kind of the financing that we provide. And I would tell you, over the last couple of years, we've never been more busy. Business has been extremely strong. 2020 was a record year for us, and 2021 is well on its way to being another record for the amount of activity that we have. So needless to say, a lot of activity in the unannounced deals. So relating to this slide specifically, there are a couple points I'd like to make. If you look at kind of the far right of that chart there, so you'll start with 2020, well, you'll see kind of that longest bar in the four colored graph lines there, if you will. So I get a lot of questions on, hey, how was 2020? What did that do to the M&A space? And, what was the impact of, COVID-19 to, folks that were considering, agencies that were looking to buy and agencies that were looking to sell. And we'll get into the exact numbers in a slide or two, but 2020 was a record year for announced deals. There was a lot of deals that were on the street. And that graph kind of depicts, 2020 in a nutshell. Strong first quarter, second quarter, COVID hits, it's in the news. People kind of pump the brakes, see a slowdown in the second quarter. Third quarter responds, a relatively strong pace. And then fourth quarter was the largest quarter by far in recent history. And you'll see to the left of that, kind of bar graph there from 2020 is the prior year's activity by quarter. And 2021 off to a strong start through three quarters, and high expectations for a strong finish to 2021 as it relates to announced deals. So here's kind of those graphs kind of summarized by numbers. So if you look at 2020, again, that first kind of set of bar graphs on the left there, that's the total number of announced deals in 2020. So that number was 791 in 2020, approximately 141 more than the prior year. But if you were to take this back from 2017 to 2016, 2015, each of those years had been a record over the prior. So this has been a trend that's been going on for some time, that the amount of announced deals over time has been ticking up. And there's various points along the way that I can remember hearing, how long can this last? Can't last long. The bubble's going to burst. There was things either in the marketplace or the economy that would point to this stuff slowing down. But as you can see, it really has just continued at a record pace year over year. And then moving to the right side, you'll see kind of the most furthest number of 553 on the slide. That's the trailing 12 months, or excuse me, first 3 quarters of 2021 is at 553 compared to the first 3 quarters of the prior years. And again, we're at a record pace already. Prior to this meeting, one of the challenges I did have in travel, I was in New York City, and Marshberry does an annual, they call it their Impact Summit, and they talk about the activity and what's happening with capital in the marketplace and all the M&A activity. They're estimating that this year's total number of transactions are going to be somewhere in the 800 plus range. So they're anticipating another record year as it relates to announced deals. So this is a busy slide, admittedly, but really the point here is kind of who's the most active acquirers in this announced deal kind of segment of activity. And, I'll start off with Agrishore. Agrishore, you'll see, far left working left to right, has been the #1 acquirer. It's a PE-backed acquirer that, they'll do right around 100 deals a year and have been doing so for the last few years anyway. And usually if there's a room full of agents, I take this opportunity to ask, how many of you have done 1 acquisition in a year? How many have done 2? And, there are few hands go up on the 1, few hands go up on the 2, and then I'll ask 3 or more. And anyone who's done an acquisition, what's involved in sourcing the deal, negotiating it, the due diligence, the actual, negotiation process, getting through closing. And then, the fun starts with onboarding the agency. Once you close it, there's a lot of work involved that, in my estimation, or as I look at these numbers, to do 108 acquisitions in a given year, it speaks to, a number of things. One, the amount of work in my mind it seems to be overwhelming, but 2, what Agrishore must have done in order to kind of create this machine, in order to find all these deals, be able to negotiate them, get them closed, get them onboarded, and move through that and do that number is just, in my mind, inconceivable. But they're doing it, and they're doing it consistently and have done it, for quite some time. A couple others I point out, like PCF Insurance, the third one down, and then the one right under them, World Insurance, both of them PE backed. And I think this speaks to how quickly private equity can get into the distribution game, if you will, start acquiring agencies. So if you look at PCF, I believe they were started in 2017. I sat next to a gentleman from PCF at the summit I was at earlier this week. And he said, yeah, started in 2017. We did 4 in 18, 4 in 19. Then they were on the list big time in 2020 with 36, and they anticipate, so they've done 31 through 3 quarters. They anticipate to do 80 in 2021. So that means they have a big pipeline and big expectations for the fourth quarter, I'm sure. But you go from basically not doing deals or maybe even existing in 2017 to be able to do 80 and being in the top 5, if not top 10 in acquirers in a given year. It shows you how quickly private equity can mobilize and get focused, find deals, and start using that capital pretty quickly to be a significant force in the marketplace. So this is probably comes as no shock based on my prior comments, but rolling 12-month activity by buyer type. And again, a busy slide. You might not be able to see the little boxes of what is represented by the colors here, but that top yellow color, the largest piece of this graph here, is really PE backed buyers. And if you look at kind of back from where they were in kind of 03, all the way far to the left, excuse me, in 2010, they were a smaller part of what was being done from a deal perspective. But now you see they are by far the predominant acquirer of these announced deals, very, very focused and looking to make a significant impact. It's followed by large private buyers and public buyers. One stat that struck me during the earlier meeting this week was an estimate of about 200 billion, and that's with a B, of capital that is looking to be deployed by private equity in the insurance distribution space. So quite a bit has already been deployed, but there is no mistaking the fact that private equity certainly has discovered the resiliency of this business. The recurring aspect of insurance agencies is very attractive. Those that have invested so far have seen exceptional returns, and that's no longer a secret. So you now have people like the PCFs of the world or World Insurance. You just have the new kind of interested party with a whole big pocketbook looking to spend for acquiring insurance-related distribution firms. So seller type, again, busy slide, a lot of colors. So I'll break it down for you. That big blue section on the bottom represents, the type of seller, which the largest segment of that seller for these announced deals is property casualty. The next largest segment is employee benefits, which is that gray area. And the third largest kind of seller type that's categorized here is property casualty and employee benefits. So it's those agencies that focus on both. So you could probably deduce here that there's certainly a theme. P&C agencies and employee benefit agencies are really the target for what private equity and these acquirers are looking to chase, and that has been kind of the case, as you can see historically, as this graph suggests. So it begs the question, and if I was in person, it would be an easier question to ask and look for responses. But it might ask or make you wonder, why these particular types of distribution entities, why are they so attractive? And I would tell you that first, the business model. One, it's recurring revenue. There's very few entities out there or businesses out there that have the level of strength that an insurance agency has as it relates to recurring revenue. So, on January 1 for your typical agency, if they wake up and say, hey, I have an average year of performance, 85 to 90% of the revenue I had in that prior year is going to reoccur. It's not based on a blank slate and go out and get it and try and get the sales going again and start from zero and build it up. You have 90% out of the starting gate. And that is incredibly attractive for, certainly agency owners and those that have been in the business for a long time. But it really has been recognized by those that are looking to invest in the insurance space as a very solid investment, just based, specifically on the recurring revenue model. Also, recent history has really also bolstered, the interest in this industry, and that is really how I'll say recession resistant this business has been. So if you look back at 2016 to, 2006 through 2008, we have the Great Recession, one of the more, economic crisis situations, at least in my lifetime. But you look at kind of the insurance industry as a whole, whether it be carriers and or agents, and for the most part, there might have been a blip or, a shortened downturn in revenue flow, particularly for agents, but responded rapidly, and it was almost immaterial in many respects. And now you fast forward to COVID and 2020, 2021, agents have responded or have experienced incredible results during this time. So it really has shown almost an immaterial impact for most of the agents that we speak with. And the general consensus in the industry is that agents have performed well and some better, believe it or not, during the pandemic. And you compare that to a lot of other industries, it just was not the case. So very strong and certainly sensitive to the economy, but not nearly as sensitive as a lot of industries. And they have fared quite well. So would not anticipate any of those factors I just suggested there to go away in the near term. And I would also suggest that the interest by private equity or any type of kind of serial acquirer is going to continue, just based on some very positive results and the incredible business model for insurance agency distribution. So this is I throw this slide in there because I get a lot of questions on, from agents, even, industry folks, people from carriers, and admittedly, it might be a little dated, but I think the concept is certainly still relevant. What are agencies trading for? What's the multiple these days? And we just went through a series of slides where we talked about announced deals, and the beauty of announced deals is that it's really something that we can point to that talks about the activity and what's happening. But in most cases, those announced deals are significantly large, typically regional or at least significant revenue agencies that generate a large profit margin, and you might have a number of interested parties, typically represented by a consultant on the sell side, that brings all these parties to the table, and it allows many times the sellers to kind of maximize that value. So that's kind of one segment of the marketplace, as I described earlier. They are announced deals, and they're announced for a reason. And I took a snippet from Marshberry's March 2020 Counterpoint magazine, where it starts talking about agency comparables from a maximum multiple perspective of EBITDA. So EBITDA, earnings before interest, taxes, depreciation, and amortization. The best way I can break that down to layman's terms, it's really your net income after adjustments, and those adjustments are the income tax, depreciation, and amortization. Could be others. But really what you're trying to find is really what's the free cash flow of the agency. But looking at this quickly, in 2019, I'll use the example, which is the far right in that graph there. There's 9.03 as a base purchase price. So what that means is that that's kind of your guaranteed money. If I'm a seller, 9 times EBITDA would be what I would expect in the form of a check at the closing table. And then you have a portion of the negotiated purchase price, which is kind of variable based on performance, or in this case, it's described as an earnout. And there's likely a number of aspects of an earnout that need to be hit in order for you to kind of maximize, or reach that maximum purchase price. So in 2019, the maximum purchase price was 11.74 on average. For Marshberry's study here. So 9 points of that would be, your guaranteed money, that's cash at closed. And then they have a realistic earnout, meaning, based on all of that variable aspects of your negotiated purchase price, it's likely that you'll get another, 0.8 or so in earnout over time. So your maximum purchase price at that point would be, closer to 10 times EBITDA. And then maximum earnout would be 1.93. So that potentially could be left on the table if you do not hit all of your prescribed aspects of the earnout, certain amount of growth, profit, et cetera, finding other agencies to buy. There might be a number of components to that to reach that 11.74. So as you read some of these articles and you see this information in Insurance Journal or whatever it might be, Big Eye Magazine, there are all sorts of discussions on kind of what the multiple looks like on some of these larger deals. And you'll see, people like Marshberry and Reagan and others comment on this, and they'll talk about the maximum multiple. But you do need to remember there's components to that: guaranteed money, variable compensation, who actually gets paid that full amount at the end is really subject to the performance of the agency. But it can be somewhat misleading. And if I'm an agency that's not necessarily a candidate to be purchased by private equity, I might read these articles and say, hey, my agency is worth, close to 12 times EBITDA. And I assure you that in most cases, if you are not a target for, those type of buyers that, kind of fall on those announced deals, that the likelihood of achieving that type of multiple is not great. So Live Oak Bank on the right-hand side of that slide, we did a kind of review of our results for about 15 months, 30 acquisition loans, and took a look at kind of what was the purchase price in those situations. And again, remember, these are kind of agency owner A buying agency owner B, private deals, not necessarily the most sophisticated situations, but ultimately, these are the numbers that we came up with, that on average, it would be about 6.2 times multiple of EBITDA. So big difference than what you're seeing on the Marshberry slide there. And we kind of backed that into saying, hey, from a multiple of revenue, what's that look like? And 2.25 was, kind of the average multiple of revenue for the 30 loans that we looked at. So where you see people discussing in the marketplace, yes, there's a lot of activity. Multiples have actually probably have gone up, even slightly more in our example on the right-hand side. From that average multiple of revenue could be 6.5, 7 times, at this stage, because competition continues to be great in this space. There might be multiple people interested in it, and the price of, poker goes up when that happens. But ultimately, our view on this is that we are in the affordability business. There might be someone out there willing to pay 12 times EBITDA for an agency. The folks that we're dealing with, we have to make sure that they can afford that. And if they need debt in order to get that done, I assure you, in most cases, a 12 times multiple would not work with traditional financing. So we're kind of that governor, if you will, as it relates to the person that needs debt in order to make these happen. But brings the realism to some sellers that, you're not going to get some of these multiples that you're reading about in the paper. And again, in the stat I'll leave you is that 83% of agents have less than 1.250 in million in revenue. And that's really the space in which Live Oak is really playing in. We work with a lot of agents that are, up to, 10, 15, maybe 20 people on the large side. But there's a lot of 1s and 2s and 3 employee type shops out there that we work with that make up the vast majority of the agencies. So when you're looking at some of the information out there on multiples, it's good to kind of peel back the onion, if you will, to make sure you understand what you're looking at. So what are the driving factors? Why is all this activity out there? And, one of the things that has been the case for a while, probably doesn't come as a surprise to many people as part of this meeting, is, agency owner demographics. And again, the chart on the right is from the agency universe study that I referenced earlier. And, just kind of summarizing some of the things that you see there, about 30% of the owners, and these are agency owners with 20% or more in equity in their business, 30% of those folks are greater than 65. And just going a little further down, about 49% of agency owners are 55 or older, or older than 55, I should say. So the agency demographics continue to point in a direction that people either should be or are considering what to do with their ownership and transition of that ownership. And that's as it stands as of 2020, 2022. This report will come out again. But the numbers have been relatively consistent on kind of what that looks like from an age break. And, how do you look at those numbers moving forward? It does point to just people aging out of the business and need to do something from a transition of ownership. Multiples, we just kind of talked about that on the previous slide. I'll call it the PE influence or private equity influence. The amount of activity and what's going on and what's being reported really has influenced, the overall purchase price, even when private equity is not involved. It's just a very robust market. There's many people interested in acquiring. There's more buyers than sellers. And it just creates this marketplace where there's a lot of pressure on multiples to be higher. And great for sellers, can be a challenge certainly for buyers. But that trend has continued, and we continue to see greater multiples out there. And many people are looking at that, say, why not get while the getting's good? We're in a relatively low interest rate environment. Right when COVID hit, the prime rate was dropped, I think by a total of 200 basis points, has not moved since. So if you're looking for debt and you need a loan, not a bad environment to get it, certainly as it relates to interest rate. There's certainly availability of capital. I mentioned what's out there from a private equity standpoint. But we're a bank that's not private equity backed. We're not doing anything in that space from an insurance perspective. But we certainly have capital that we're looking to put to use in this industry, and there are, believe it or not, competitors of ours that are looking to do the same. And then a lot of talk on potential for long-term capital gains. And that is certainly a topic that's kind of bounced around. Don't know where it's going to fall, but I would tell you we were fielding calls all year with people that had concerns around that and wanted to make sure that if they did sell, now was the time before, the potential for capital gains to be increased significantly. Doesn't appear that that's going to be the case. It looks like there will likely be some level of increase. The timing of when and how much still needs to be seen. So these factors, for the most part, are going to be near-term issues, and some of them are going to be longer-term issues out there that people wrangle with as they try to decide whether they want to sell or continue to buy agencies. But it doesn't look like it's going to be slowing down anytime soon. So overall, what's the impact to distribution? So if you think about if you're in great crowd to ask this question, but, or make this statement, but if you're an insurance company right now and you're looking at the landscape of the independent agency system and where is it heading and what's this consolidation mean for me or for my company now and in the future, it does create a number of things to consider. So first being, we've talked with a number of insurance companies that have had, a number, it might not be a large number, but a number of agencies that have been acquired over time. And then, they kind of overlay that over their geographic coverage of, particular state or territory or however you want to break it up, and do find gaps that there's been enough acquisition activity in certain areas that they feel that they're underrepresented. Not that every time an agency sells, you kind of lose that agency as a potential, distribution outlet, but we'll talk about some of the challenges associated with that. But, as acquisitions do occur, it does kind of change your geographic representation potentially. Difficult to anticipate. The folks that we talk to, on the carrier side, typically don't find out about an agency acquisition until the day after it has occurred. So it's not like, a carrier's got the opportunity to really plan and make, educated decisions on what they need to do with that particular agency or that particular region, because you do many times find yourself in a situation where the deal has already happened and now you're in a reactive situation. Larger books of business with fewer agents, that may be a good thing. It might be an efficiency play for insurance carriers. At times though, I've had some conversations that, from a leverage standpoint or, having fewer agents isn't always necessarily the best thing. Having the wealth spread amongst a number of agencies probably was the strategy beforehand, and, kind of reducing that doesn't necessarily always give you the results that you're looking for. Spinoffs, we've worked with a number of agencies that have started as a result of this acquisition activity. Someone that was maybe a minority owner in an agency that got acquired, or a producer in an agency that was not happy with the direction moving forward and has left and started their agencies. So that has been, certainly a positive for us, and has helped regenerate some of those numbers that we were talking about from a number of insurance agencies out there perspective. Some carriers are replacing long-established relationships with new ownerships and uncertainty. Some of these agencies, or many of the agencies that are being targeted, are the best agencies. They're acquirers are looking for really good agencies with a long history, very profitable relationships. They're looking at all the things that you would likely look at as if you were going to appoint one of these agencies. But now you have a situation where your 30-year relationship or your 50-year relationship with the owner, or that ownership's family, or that particular agency, is now replaced with somebody that's making a decision at a pretty high level that's not even in the territory. They could be thousands of miles away. So a whole different dynamic on how conversations need to occur. Who do you talk to? Who's actually making the decisions? And that can kind of throw a few things up in the air. And then need to appoint new agents. If you do find yourself in a situation where your representation in particular areas is not great, how do you kind of go back through and appoint new agents? Certainly not an inexpensive or fun process in appointing agents. And it's not like when you appoint an agent, they're up and running the next day. There's a lot of education, handholding to getting to the point where they're a productive agent without on cruise control, doing their own thing and writing business along the way. So here's where I kind of pivot to some thoughts on maybe changing a perspective from being a reactive observer of what's happening in the distribution space to being more proactive and addressing the challenges that are potentially facing your firm as it relates to distribution. But many of the challenges that agencies or owners are struggling with as they, grapple with the issues of, aging out, or, potential family members that want to get into the business, or do I sell? If I sell, what's that look like? How do you position yourself to be part of the conversation? And, I gave this presentation over the summer to NAMIC over a webinar. And one of the questions that I had, which I thought was interesting, is, how much do we need to get involved in order to, make some of this stuff happen? Like, when's too much, which is a great question to ask. And I think it's something that, everyone needs to kind of determine on their own on how far into this do you want to get. But I would say, the flip side of that is, there's a number of, insurance companies that we work with that really aren't doing anything at all in this space to help their agents as they, kind of deal with the inevitable. At some point, an agency owner needs to transition the ownership. What's that look like? And you want to be part of that conversation, or at least positioned to be part of it, is really up to you and your kind of long-term strategy. So be part of the conversation, be a valued resource in this area. If you're not bringing it up and you're not seen as somebody that's trying to help or provide resources, you're more likely to be the one that's informed post close of an agency selling their agency than maybe being well aware of what their plan is and potentially impacting that with resources and helping your agents in that area. Probably a number of my comments, moving forward will sound like this is a defensive play. How do I protect my agencies, as they move forward from being purchased by somebody else, or keep them on that independent track, which is certainly part of the conversation. But there's also an offensive aspect of what I'm going to relay here too, that there's a number of really good agencies that you could probably rattle off quickly that you have relationships with that you would like to see bigger, doing some real good things from a growth and profitability perspective. And how do you surround those agencies with resources that say, hey, why don't you go out and buy additional agencies and maybe roll some of that premium into what you got going on with your appointment with that particular agency. Leverage available resources. This is not about recreating the wheel. There's a lot of resources out there that are available that are willing to work with insurance companies to help their agents, and their kind of payback, if you will, would be kind of the engagement that they have with the agency So when I mentioned create a cost-effective approach, you could basically put together what I'm going to talk about today at relatively no or low cost to an insurance company by utilizing existing resources and being able to kind of move forward. And I say existing resources, many of those are outside resources that are willing to work with an insurance company for relatively no cost. And then strategy to develop relationship with PE and large buyers. And this is a recent addition to my slide deck, because in the past, I think a lot of my conversations and discussion points were around kind of how to prevent what's happening in the PE and large buyer space. Give the resources to your agency so they can continue to kind of stay on the trajectory of being independent, kind of working in that phase, which I still think is important and something that should be a focus. But I don't think, stopping this kind of tidal wave of private equity and large buyers is going to change. So I think having a strategy on kind of how do you embrace that, if that makes sense, because it's likely at some point that one of your real important agencies is going to be bought by, somebody that's large, out of town, whole different management strategy, and they are evaluating or have a business model when they acquire an agency that might be very different than how you've interacted with your current agency plan. And maybe, specifically how you've been interacting with the agency that they just bought. So understanding what that reaction might look like, how do you build some bridges in order to create some continuity with your book of business would be well worth your time in working through. So when we talk about resources, think of it in 6 buckets. So work with agents, and these would be what an agency would need in order to kind of work through a transition of ownership. So valuation resources, information and direction on how to perpetuate an agency, how to buy and sell an agency, the legal, CPA, and financing are all aspects of transition of ownership that I would tell you from doing this day to day and fielding phone calls from agencies. A lot of them don't know where to turn. They don't, they might have, some level of direction on, the attorney that they used for some, transaction in the past that might not necessarily be focused on insurance agency M&A. So there's things that you can develop as a, kind of ready call list, if you will, of resources that, you could put out there or, kind of organize in a way that, we'll talk about how to get the word out and how to make sure that people are aware of it. But if you think about it in these 6 buckets, there's opportunity to do something here that is valuable to your agents. So significant number of valuation firms out there, all willing to do, webinars, in-person meetings, obviously take referrals from you to work with their agents. But every agency call that, that I have, front of the first question, even, many do not have a valuation report when they enter this process. So a lot of questions around what's their agency worth? If I'm buying an agency, what's it worth? What are the drivers of value? So I might want to sell my agency to my son in 5 years. And if so, what are the things that I can influence now that will be a driver of value for the insurance agency? So when we do get to the point where I want to sell it, and maybe it's not internal, I want to do it external. All of these things are really, really important to understand. And many of them take time to implement and, position your agency in the best possible situation to maximize value. And a lot of it is time sensitive. So the sooner the folks are thinking about it, the more action and more effective action that they can take. A lot of education on internal versus external sales. Frankly, an internal sale is typically a lower purchase price than an external sale. And that's a general statement, not always the case, but in many situations that is the case. And many people need to grapple with that early. If I want to sell internally, but I have these kind of external sale price tag in my head, many times that doesn't work. And you need to reconcile that early. The earlier, the better for all parties, particularly the internal folks that are interested in buying the agency, that there might be a situation where there might not be a meeting of minds from a purchase price standpoint. We talked about maximizing value. And big part of valuation process is understanding the issues that create either deal value or take away from the deal value. What are those red flags that somebody should be looking at so they can be an educated buyer and understanding, kind of what should and should not be considered as they do their evaluation of an agency opportunity. Perpetuation, a very important topic throughout, we'll probably call it decades. I've been in the industry about 35 years, and I can remember agency perpetuation being a topic, back then. And it continues to be. I think really what you're seeing now is just a greater number of, baby boomers and agency owners that are looking to get out now. So perpetuation probably has never been a more important topic. And you talk about an agency transition that requires probably the greatest amount of pre-planning and execution along an agreed upon timeline. Perpetuation is certainly it. So, when to start, establishing priorities, some agency self-evaluation, making sure that people are thinking about it appropriately early on enough to position themselves to sell, but also the buyers to buy is going to be important. So in my estimation, you can't give out too much information on perpetuation, but again, a lot of the valuation firms I referenced or think would be a good fit for what I'm talking about here. Perpetuation is part of their bailiwick as well. Buying and selling agencies, we talked about, are there a group of agencies that you think very highly of that are up and comers or have the youth, energy, expertise, smarts, et cetera, that you want to put around, particularly buying agencies, help them get bigger, create some business plans around that, and really make this a differentiation aspect of how you treat your agencies. But also on the selling side, there's a number of folks that, I ask all the time when we have carrier people, are there agencies that you're working with right now that should have or should be considering selling their agencies? And I'm sure everyone could put together a pretty short list of what that looks like. But many times people make a decision on Monday that they want to sell on Tuesday, and they just haven't given themselves enough time to kind of prepare themselves, their agency, their employees, and others to be able to sell that agency effectively and looking to maximize that value. So certainly an education piece as well. It also gives you an opportunity to get a glimpse into, you have one of these type events or education situations, and you get an understanding of who's looking to sell. So maybe an opportunity to get a peek behind the curtain of who might be considering selling. So legal firms, there's a lot of great firms out there that do M&A work. There's a number of, I'll call them even better firms that do insurance agency mergers and acquisitions specifically. And as we all know and can agree, the insurance agency has, or, the insurance industry has its own vernacular in a lot of respects, a lot of acronyms, a lot of things that we probably take for granted on how many are out there until you now have someone trying to figure out this business from a financing standpoint or from a legal perspective. So we've had, quick story, I got a call from a consultant and saying that the kind of the buy-sell agreement between two partners, in the document, it had a clause that the firm would be sold to the partner in the event of death for 2 times written premium. So 2 times written premium created some, $60 million valuation on an agency that, it's generating, maybe $3 million in revenue. So that legal document alone, you now have, a spouse that's trying to figure that out and is pointing to a firm that or a document that everyone signed, but just the terminology was incorrect. And to this day, I think I got that call probably about 2.5 years ago, and I still don't think everything's finalized. So working with a firm that specializes in it can make a difference. And there are some great firms, even some in Pennsylvania that come top of mind. So it is nice to have that opportunity to refer folks. And CPAs as well, and I'll say this is more, tax strategies and accounting aspects, not only for running the existing operation, but mitigating the tax consequences of a sale, and even through an acquisition, maximizing some tax advantages that you could get is going to be important and should be part of someone's process as they're either looking to buy or sell, having that type of resource available to kind of walk through what that process looks like. So this might be the most self-serving slide on the whole deck, but Live Oak Bank does provide financing to insurance agencies. nationwide. So it's something that we focus on. So a few observations as a former carrier and agent guy coming to, starting the insurance lending vertical in 2015. There's not a lot of banks that understand the insurance distribution space. It's an intangible asset. Most banks are looking for buildings, equipment, inventory, vehicles, things along those lines, things they can touch in the event of default. So financing an insurance agency is not top of their target list. So making sure that your agents, are aware of it, you have sources to kind of point them to, can save them a lot of time, effort, and angst if you push them in the right direction. There are pros and cons of seller finance, and sellers do finance quite a bit of either a portion or entire deals these days. So that's still alive and well, but there's things to consider as you evaluate, going down that path. Preparing to secure bank financing, just understanding the process and what a bank's going to be looking for. The sooner you know that, the better, and the more you can prepare for it. And then, factors of what lenders use to make lending decisions. Many people just kind of come to us saying, hey, I got these tax forms for my agency, what I'm looking to buy, will you fund it? As opposed to really having it thought out, this is how the numbers work. This is what it looks like. This is why I think it's important and profitable and would be able to afford the debt. And that's not, rocket science when it comes down to what you need to do in order to prepare for that. Lending process, borrower qualifications, just makes somebody a better candidate for the bank as they approach it. And, the more prepared somebody is, the more likely they are to get the financing. Some cases we work with people that, don't even have an identified target, but know they might need it at some point. So we kind of walk them through what this might look like when they do come to the table looking for a loan. So how do you kind of take what I just shared with you and kind of put it in some organized fashion? So there's a good chance, and I'll go out on a limb here, that if you were to survey your agents and gauge interest, you'd probably get a strong response that there is an interest in this, and people want to get educated in a way that's either non-threatening, in a way that can be anonymous if they're interested in it, or interested in remaining anonymous, particularly from a selling standpoint. But putting it out there to say, hey, is there an interest? And don't take Mike Strachov's word for it. Find out from your agency plant directly. Probably determine the best way to coordinate offerings, identify partners to deliver the content, or probably hand in hand in some respects, but really understanding what that would look like. What do you want to deliver, maybe based on that survey? What's the best way to kind of go about delivering the content, and who would you recommend being the deliverer of? Develop a content calendar. Most folks, most carriers either have an in-person meeting, an ongoing webinar series, you have newsletters, you might have blogs, but there are various outlets that this content can be shared with your appointed agents. Really always recommend kind of doing this on either a 6 to 12 month basis, so you have an organized rollout and what it looks like. Who do you want to share this information with? Who would you like to be part of the process? Is it part of your agency differentiation program? Give certain aspects of this type of education to certain agents to be viewed as a benefit, and being a kind of high priority agent with any particular insurance company. And then reinforcement of the message. I can't tell you how many times I get people that have a call that they said, hey, 3 years ago I heard you do a presentation for PAMIC, and didn't have an opportunity at the time, but now I'm 3 years older, I want to sell my agency, would like to re-engage. So making sure that people are, always thinking about it, or at least being reminded of it, can be important. So the summary slide, agency consolidation will continue for the foreseeable future. So plan on it, or I'm going to put for it. There's really no indication that this is going to slow down anytime soon. And like I described earlier, maybe there's a little too far to one side, but to kind of being a passive observer, learning about acquisitions after they occur is one approach. And then the other side is really kind of jumping in and saying, hey, I want to provide some information and resources to my agents on a planned basis. So they're educated, informed, but also see me as someone that they can come to, ask questions, go for direction with regard to resources, positions you in a much better spot than maybe just kind of dealing with things as they happen. Developing a proactive plan to be part of the solution. can be important. Obviously, if you're going to go down this path, you just want to make sure you do it right. And, provide the information that people are looking for. And that could be, through a pretty, not overwhelming plan with resources that are currently available. And, that's last point, there are resources that are available. I'll tell you that we do work with a number of NAMIC NAMIC members that have utilized us kind of as that coordinator for those resources. Should have led with this earlier on, but Live Oak has been a member of NAMIC for 5 years now. So shortly after getting into the insurance lending space, we joined NAMIC. So we've been proud members of NAMIC for quite some time. And, most recently I was on the committee that developed the national meeting. So we've been active with the group as well. So with that, my last slide, pretty as it might be, sets us up for questions. So if anyone has a question, I'd be happy to entertain that at this time.
See me, but I want to introduce myself. I'm Ron Gallagher with PAMIC as well, and I'm going to try to coordinate any of the questions that we do have. So for the audience, because we do have a good number of people attending virtually, we have a microphone that we need you to speak into so they can hear the question as well. So do we have any questions for Mike? I got to tell you, this is a very important topic for all of us, because how do you get your products into the hands of the consumers? And I'll share, Mike, I'll share this story with you because it's just recently came up. You mentioned in your slides that, we have an aging producer population. Whether they're individuals or they're agencies. And recently I got involved with a situation where an elder gentleman passed away. He happened to have appointments with numerous of our PAMIC members, but there was no perpetuation plan. And as a result, it's been throwing a lot of their work into turmoil, because there is a family member who's interested in acquiring the business, but they're not licensed and all this other kind of stuff. So it just makes servicing policyholders and doing anything else very difficult. So I think the takeaway I have, Mike, is that as proactive as you can be with your agencies, especially if you want to pick out single proprietor agencies that are starting to get a little bit older, would probably be a very good thing to focus on immediately. Now, you can't help what happens when an agency owner decides to sell. I mean, that's usually very quiet until it happens. But your agents and your agency. So I would be as proactive as you can. And I think, Mike, that was sort of your approach as well with all the information you provided. But anyway, do we have any more questions or any questions at all for Mike? If not, I want to say thank you, Mike, for excellent presentation. I appreciate it. And we will be hitting a break in a second, but I do want to share some comments, since I wasn't here first thing in the morning to share some really good news. Not that I'm just retiring and you won't have to put up with me next year, but some real good news that we hope will affect our industry very soon. So Mike, with that, we want to say thank you.
Thank you for having me. Really appreciate it.
Okay, great. All right, so you guys happen to be the first audience that I actually get to share some legislative news with you. And if you had a chance to read the PAMIC 360, it may be a repeat. That came out yesterday. That's our digital kind of government affairs update and that kind of thing. We got 2 bills passed out of the House Insurance Committee on Monday. Those bills are House Bill 1679 and 1680. And this is a perfect audience to talk about these bills, not in great detail, because I will promise that we will put a webinar on to go through the details once these bills actually get out of the House and into the Senate. But the bills basically will allow you to alter the terms of your contracts at renewal. It's homeowners and auto. One bill deals with homeowners, the other bill deals with auto, without having to go through a pretty onerous non-renewal process here in Pennsylvania, where you have to non-renew the whole book of business and that kind of stuff. Now you'll be able to make certain changes without having to go through that entire process. The bill came out of the House Insurance Committee with a unanimous vote. That means both the Democrats and the Republicans supported it, which is important because it sends a strong signal to the rest of the House. This is truly a bipartisan bill. Also, it sends a strong signal to the Senate when it finally gets up there. So you could read about the bill in the PAMIC 360 to get yourself a little bit more educated on what's going on. But Britt, please remind me that we will do a seminar, a webinar sometime in December just to go over those specific details. With that, I think I just took up 5 minutes of your morning break. So let's just take about a 10-minute break. I'll get back here at about 9:45, and then we'll kick off with another, I know, excellent presentation by a very good friend and colleague of mine. I don't see Evo right here, do I? Raise your hand, Evo. Is he virtual? Oh, he's out there. Sorry. All right, take your break now, and we'll see you back at 9:45. Thank you. If we can get our seats, we can get started again and hopefully keep the program on track. Mr. Stone, I have a job for you. Get everybody to the tables. Because we have a very important person who's going to be talking. Yeah, no, you are. You are. You are. Go ahead. So our next segment is dealing with that other side of insurance, dealing with insurance fraud, the thing that costs everybody money, from consumers to companies. And it's a very important topic. And the industry itself also finds it very important. They fund many activities, like in Pennsylvania, we have the Pennsylvania Insurance Fraud Prevention Authority. Many other states have the same thing. And it's your dollars that go to support those kinds of things. But we also have experts in the field on investigating insurance fraud and those kinds of things. And one of those companies is owned by a very good friend of mine, Evo Riguzzi. He's a recovering New Yorker now, right? I can't even spell New York. Okay, yeah. So he was a recovering New Yorker, and I'm a recovering New Yorker as well. And Evo is probably well known to many of you because, one, he comes to a lot of our events. He goes to NAMIC events. But I want to also point out, because we're just coming off of Veterans Day week, is Evo was also a member of the Army for many years, rising to the rank of Major General, which in his career field, which dealt with law enforcement, is the highest rank you can get. And I'm very proud to say he's my friend, and I thank you for your service to our country as well, and now your continued service to our industry. So instead of reading his complete bio, which you could probably see somewhere, I just want Evo to come up, introduce himself, and let's move on with our presentation. So thank you, Evo. And I will ask, if you do get any questions from the audience, we may not be able to get them the microphone. Please repeat the question for our friends at home, okay?
Absolutely.
Thank you.
Good morning, everybody. Thanks for the intro about Veterans Day. Anybody else here a veteran? Well, we give you a salute too for your service. I had an interesting Veterans Day last week. I can't spell New York anymore because I'm not a resident of the state anymore. Thank God. And I am now a legal resident of the state of Florida. And I'm going to tell you, it's entirely different. And as I was explaining to a couple of folks earlier, anybody here have Easy Pass? Easy Pass? Okay. So in the county of Dade, which is where Miami is located, there is a expressway authority called Miami-Dade Expressway, MDX. And in the paper the other day, I mean, just think about this now, Easy Pass people. The MDX authority will pick up your tolls on what they call Sun Pass. And there was an article in the paper that said if you spent over $100 in an 18-month period, you could apply to MDX and they would give you a 15% refund. Anybody ever get a refund from Easy Pass? I think the difference is just remarkable. Let's get into the program today. I think I'm gonna, this work right? Okay. I titled it Today and Tomorrow because the world is evolving, and the last year, I believe you all have seen a dramatic change to not only the way you operate inside the office, but there's been a change and shift in demographics and other requirements that may be affecting how you underwrite your business. So we see, people ask me, oh, you do fraud. What's your line of business? What lines do you handle? I handle any line that my clients underwrite. And that could be really, it's across the board. We have companies that write medical malpractice for psychiatrists. And you might say, where would the fraud be with that? And yet we've seen it. So it doesn't matter the line of business. Where do I see the most fraud, the most cost of fraud? Let's put it that way. It's the medical side of the house. Why? Because it crosses a number of lines. So if you write general liability, if you write any kind of bodily injury, you write any kind of workers' comp, any kind of auto, to the person that's producing the phony medical bills, they could care less what line of business you're in. They're just going to push it. The only difference I would say perhaps is in personal injury protection, commonly called no fault, because the limits on some of those policies are incredible. And New York has a $50,000 cap. I think New Jersey has much $250,000. Even the $10,000 one. See, actually, the $10,000 cap is harder to fight than the $250,000. Why do you say that? Well, if you have somebody on staff or you hire somebody like me to investigate it, how much money are you going to spend on a $10,000 claim? You're more than likely just going to pay it or maybe mitigate some of it out. Where if you got a $50,000 claim, you're more than likely to say, can you get a surveillance? Can you do some other tactic to defeat it? So any one of those lines. Identity theft is a problem. You may say, how does identity theft affect you? Because people will take somebody else's identity and then jump in a car. People will take somebody else's identity and then claim they slipped and fall. So it makes it harder to figure out who they are. Even in the workers' comp arena, with the high influx right now of illegal immigrants to the country, a lot of these folks are going to have to work or want to work. I mean, they're not bad people in that sense. They want to get out there and make a living to get themselves better. If you listen to the news as they're interviewed, they're always talking about the fact that they want to come here for the opportunity. So they're going to filter into your market. Do you think they're going to use their real names? Do you think if you ask me to go do a background investigation on them in Mexico, I'm going to be fruitful? You know, we don't even touch South America and Central America on doing cases because I can't verify the information from a reliable source. So you're paying me, you know, to stir the pot, but I'm not sure I can give you a quality work product back. So we see that by the way, about 2 years ago, we handled an enormous investigation involving policies that were sold at the airport for travel insurance. Now there's no verification, right? Underwriters, there's no verification at that. You go up to a machine and you buy the policy. I don't know who you are, right? We had well over 110 claims come in for people who were injured when they arrived in Colombia or in Ecuador or Paraguay, or that they lost their luggage on their way to the Dominican Republic. And interestingly, everybody that lost their luggage on the way to the Dominican Republic had receipts from Nordstrom's. Everybody. Now, I don't know whether they put that, I don't know, how do you put that in your pocket and then get on the plane and you lose your luggage? And oh, by the way, I've got my receipt. Fascinating the way it worked. And we were handling one company's accounts on that. It turned out there were like 5 other companies that had sold those, that sell those policies, you know, at the airport or over the internet. And there again, there's no verification. You don't know who you're insuring. You don't know the risk. So part of the process and this again, today and tomorrow, has this changed? And I'm going to show you a video that was made, or actually a movie that was made a long time ago. It's black and white, Edward G. Robinson in it, to show you how fraud was committed then. But today and tomorrow, it's yesterday, today, tomorrow. It hasn't changed. In fact, it's gotten more pernicious. So you see that the kids are doing this. Now, anybody here have children that are in high school? All right. Did you ask them how they were doing their assignments from distance learning and whether or not they were able to kind of weasel their way around the assignment? I mean, most every kid that I spoke to, and I've got a bunch of grandkids, they all said, well, yeah, we were able to fudge the system because, you know, we figured out how to beat the teachers. And that was the game. Were they really learning? Probably not. But cheating starts back in high school, particularly. And it doesn't end at graduation, is my point. So not only you as an employer bring in folks from the outside who have possibly cheated. We're hoping you didn't, but this is life. And these become your insureds. These become your claimants. These become your contractors that you hire to fix or repair, or independent contractors that you use in the course of doing your business. So it doesn't end. It's pernicious. It really is in there. The other piece is that the money is high and the penalties are low. Think about it. We've seen, Powerballs, right, that are half $500 million. It's nothing compared to the insurance fraud. Now, as a taxpayer, you see that bullet there, $80 billion in Medicare fraud. That number hasn't changed in the last 10, 15 years. Medicare has not gotten any better at knocking down insurance fraud. And that's the medical side of the house. That's why I say it's the worst of all of them. So if you're involved in the medical piece and you're underwriting those risks, or you're checking those risks, you have to do your homework before you put that risk on your books. I don't care what you bind. Makes no difference to me. Fact of the matter is, the companies that write non-standard auto are my best clients. They give me the most work. I make the most money off of them. So it's against my better interests, right, to push against this. But the idea is that the fraud can go on in that system, and they are unafraid of the federal government. Unafraid of the federal government. What does the federal government have that Evo doesn't have? Now, somewhere maybe in my bio, I don't know, I pare them down for the occasion. I was a federal agent at one time. I did have the ability to go into court and get a search warrant to arrest you, to put you in jail. I had to go prove it to a judge that I had probable cause, but I could do it. Evo now is just a private investigator. I have nothing but my American Express card to influence things. So the idea of being able to go into court and get something done is almost impossible. And for most of you companies, you're all small. You haven't got budgets to support that. It's a lot of money that you would have to lay out if you really wanted to get somebody prosecuted, if you're going to do your own investigation. So again, the Coalition Against Insurance Fraud has been around, I think around since around 1990. They've been in business a long time. Anybody a member? Yeah, again, it's very expensive to join that, but we pay attention to what they write and they say in their white papers. And they're saying that 10%, Allstate says 10% of all insurance transactions are fraudulent. Now, more than likely in the mutual world, you haven't got that kind of exposure because of the nature of your business, who you write your business with. But it doesn't mean people won't try to pull the wool over your eyes. Again, the public's attitude and your attitude. The last line here is that 68% believe they can get away with it, and they're correct. The vast majority, we refile, hundreds of referrals with the states in the course of a year, and our business is national in scope, so we file in all sorts of states. Now, where do we get the most attention? It's the states where there's the least population, and we can get the attention maybe of a district attorney. But even then, so this big scam we did that originated out of New York with the fraudulent travel claims, the numbers were high. We were able to show $750,000 in phony insurance claims on just the 100 cases we worked. I don't know what the other companies that were part of that referral process, reported, but the state said, well, it's in South America, it's in the Dominican Republic. These aren't places we really can go and get records, and it's too expensive for us. And so the case never got prosecuted. And that's what happens. And I know Ron talked about the fact that you all contribute to the Insurance Fraud Prevention Authority here in the state of Pennsylvania. And annually they run a conference Usually it's in Hershey once a year, bringing in investigators, both on the public side and the private side. And they give us a nice jacket every year. And that's the way your funding is. Don't give me the jacket, go fight the crime, is what I would prefer. I mean, they're good people, they all have their agendas, but you know, the idea is you have to fight it and you have to recognize it. Now, this video I'm going to show you, you may have seen it, taken the training from me before, is a staged event. Now, usually we do staged events with auto, you know, swoop and squats where the car pulls in front of you, jams on the brakes, whack, you hit them. Here, this happens to be, let's go. This happens to be a general liability claim. The landlord was really smart. Landlord knew he had a tenant problem and put a camera in the hallway. So this is all done by the landlord. Now you can see it there. The guy in the red shirt is squirting water on the ceiling from a bottle of like Dove. I think it's just water. We don't see any bubbles. He squirts and he looks on the floor. So you're putting it up here to see how much comes down here, right? He's not satisfied. Got to go back and get some more. Now, why would you do that? Now, here's his, he shares the apartment with this gentleman who comes out with his iPhone and is now videotaping the ceiling and the floor. What's he doing? He's creating evidence, right? I have evidence now. You, landlord, you were negligent. There's water on the floor, leak from the ceiling. You never fixed it, right? So he videotapes it. He's lucky he didn't slip down the stairs with that toothbrush in his mouth, you know? And they file a claim for slipping and falling and being injured going down the stairs. Now, one of the great things about a video like this is empirical information. It is not biased. The camera does not lie, has no agenda, and it puts forth exactly what we need. I mean, we put in a claim. So you got to let them go through the process. Put the claim in, make the lie. You know, there's that little statement down the bottom. It's, if I make a fraudulent claim, I'm subject to A, B, and C. Go to jail? No. We just make the claim, what? Go away. That's the deal. Another case. Again, you may go out, you underwrite a facility. You don't think you're going to expect it. This facility, by the way, it was a social services. So it was run through like a church organization to provide housing for people who need housing. So a woman claims she comes out of the apartment and she slips and falls on the ice, right? Ice, it's an issue, right, folks? I mean, again, when you're underwriting, when you're doing your loss control and you're looking at the facilities, you have to take in the weather as part of it, right? We do it for hurricanes in the south, for sure, tornadoes in the Midwest. We've got to do it for ice anywhere in the northern part of the country. Right, she makes a demand for $325,000. Company went out, they got an IA, independent adjuster. He went out there and he couldn't get any kind of surveillance video. In other words, we were looking for cameras that were already placed in the area to see if we could capture this. Couldn't find it. Turns out that a security guard, you know, they get to know the people in the area. They find out that the daughter had visited the mother after the event, and the daughter was very upset at her mother for making a claim against a facility. It was, in effect, providing humanitarian assistance, giving you housing. We assisted with part of it. We were able to find the ambulance records. Now, the stupidity of this claim is, why would you file a claim against a housing authority when you could file it against Wells Fargo? I mean, sometimes I just marvel at the dumbness with which we have to deal with. Why would you do that? I mean, now you've got even a prejudice claim with Wells Fargo, because this is going to get indexed into the ISO system. And when Wells Fargo goes in, they're going to want to know what the heck we did. and they'll come to us. And that's one of the good things, by the way. It's one of the great parts about being a special investigation unit is that we can go to the special investigation units of the other company, of your adversary technically, and ask them for their information. And we can ask them for information on their underwriting, their applications, or claims. Depends on the state, depends on the other company as to whether or not what they will share. They don't have to. You're all not members of the National Insurance Crime Bureau, and that's the facility where this can go through. And again, expensive membership for probably very little return. Primarily, NICB is really good on auto. They're really good on auto. And oh, by the way, their website still has a VIN, VIN for your car, a VIN check. You can go in and take, if you're going to go buy a car, I know you can do Carfax. They give them to you right off the bat now. But you can always take a VIN of a car and plug it in there and see whether the VIN is good, one, two, whether there's ever been a claim on it, especially for floods. It all started after Katrina. So many cars got flooded that they were shipping them up north for us Yankees to buy that we wouldn't be smart enough to figure out that they were, in salt water. All right, so again, doesn't make sense to me why somebody would do this, but a lot of what people do. I've used this slide for years. And Mr. Buffett, kind of a wealthy guy. I think he owns a couple of insurance companies. The whole idea is you can't deal with the bad guys. The question is how do you know what you're dealing with? Or with whom are you dealing? Again, mutual companies, you're into the game of knowing your clients really well because you have long-term relationships, but people change. Their circumstances change. Don't take things for granted. Don't take things for granted. Again, who are you dealing with? I know sometimes with the agents, it drive you nuts. So the applications that filter through either an agent or a broker system to get to you, whatever your production line is. Do you know the geography and demography of the area? Things have changed, folks. Think about where people are living today. What's happened? What's happened in your inner cities? Right? People have started to move out due to COVID. So you have less density. Is the corner grocery store you're underwriting going to be viable? Or whatever the store might be? How many businesses have gone out? Have you guys lost business because of COVID? Right? I'm sure it's gone down. Yet it's transitioned now. As the economy begins to percolate back, people have moved to different locations. We have a lot of stuff, obviously. The Amazon and the UPS world is phenomenal. You have a lot of people, packages being stolen, right in front of their house. It's a convenient way to put a claim in. Do we verify it? Most likely in the personal lines auto world, you're not doing a heck of a lot, in the overall scheme of things, because you have to move that application along to get it in. But, once it's in and done, doesn't mean it can't go back and looked at again. Are you guys who do inspections, are you getting out there timely? Do you ask questions of neighbors? Do you check police records? Do you check the neighborhood? If you're outsourcing your inspections, the inspector has to drive into the area. Well, pay him for a couple more miles just to do a loop around the blocks to see what's going on. Again, your Class A building. I got people telling me that, we use Google Earth to see you can't see everything from Google Earth. I don't care what angle the satellite takes a picture at. You can't see everything. And, the front of the building may look great. The back of the building may look like this. Is this your primary Class A building? Yeah, I developed this slide right after Katrina. This is New Orleans. The thinking of where the floodplains are. Great. The flood insurance program, right? It's being modified. We're aware, right? The federal government's now looking at it. They're increasing prices. Ask any, I know, I have a daughter that has a house right on the intercoastal in Miami, and they can't buy one policy to insure the house. They actually have to buy 3. So it creates a situation where they end up with one claim doesn't become one claim, it becomes 3 claims in order to get all the coverage in there. And of course, each one of those claims has their own deductibles. But the price of coverage is going up dramatically. It's more expensive for insurance in Florida than it is for your taxes in many of the locations. Right. So it's an easy example. What's happening in the hinterlands? You know, I mean, I watch the Weather Channel a lot, and you see these floods that are happening all over the place. So is your district now, wherever you're writing, is it now in a floodplain, and do they need to get flood insurance? Which we know you may, I don't know, anybody write it with the backup from the federal government? Anybody into that? You are. So yeah, it's important for you to know where those lines are moving now, right? Would you say? Yeah. And the problem with agent and broker fraud, every one of these examples I have up here, we have seen and we see at least several times every year. I mean, the easiest one is where people will produce an old deck and change the dates. And sometimes, believe it or not, Staples still sells whiteout. So they will white it out and write it in on top of it, as if you can't see it when the document's scanned. We just had one in the office the other day. The policy was written from 2009 to 2010 originally, and they put it in from 2019 to 2020, trying to get coverage. Removing pages from loss runs, you know, taking the premium. The other big one is they put a deck page that puts more coverage in order to fulfill some contractor needs to show he's got coverage from A, B, and C. We'll maybe add in workers' comp, which is something you might not even sell, but they'll put your name on it as if you're the carrier on it and just add it in there just to get the contract that they need and go to work. So you're blind to this. You know, the fact of the matter is you don't know this is happening until somebody maybe verifies the coverage. And that should be a red flag for your underwriting department. If you get a call in to somebody to verify that you've actually issued that deck, all right, just pay attention, look at it. Doesn't mean necessarily it's bad, but you might want to see when they call in to verify coverage A, ask them what are the coverages are on that piece, you know, just to find out what they're doing. Agent fraud happens all the time. I mean, just read the insurance journal or the claims journal that's produced every day. And basically once a week, you'll see somebody, you know, stole premium. I mean, it happens in the life side of the house as well. I understand that, but it's just as effective in the property and casualty side. Anybody here do surety? I didn't put this up here because we've had several cases of surety. The key to surety is that there's supposed to be an asset that in effect the bond is leveraged against, and people will you know, those assets are basically leveraged beyond belief. So there's no real asset, if you will. Okay. I know this slide sometimes drives the underwriters nuts because the word any misrepresentation of fact. All right, so there's a standard called a reasonable suspicion of fraud. And that's when we hit that reasonable suspicion of fraud, we file it with the state. Then there's also called material misrepresentation, right? Material misrepresentation is an administrative process for you folks to get off the risk. The state says any misrepresentation of fact. So, and that includes, you know, application fraud, as you can see. Prior claimant history. Excuse me, if they lie on that application. You should at least, we say in the companies, if you're a worker bee, at least elevate it to a manager. And then somebody make a decision. The question becomes is whether that misrepresentation is willful. And if it's willful, in other words, it's not a mistake, then you have an obligation to report. I don't care what state you're in. Every state in the union requires reporting of suspect insurance fraud transactions, not suspect insurance fraud, not insurance transactions. Doesn't have to be claim fraud, can be application fraud. We don't want anybody getting fined by the state for failure to comply with the requirements. And, you know, we filter those filings with the state in order to preserve your immunity. And that's an important part of it. So we want to make sure that we're doing this specifically to meet the state's requirements. So some auto red flags. All right, I got it on the claim side, but you might want to pay attention here on the underwriting side. Applications now are done online. So strikeovers are almost non-existent. But under commercial auto policies, you may still have a manuscript type application. We don't know when we get a misrepresentation on the app, who did it. We don't know whether the insured did it, a broker did it, or the agent did it. No better than anybody else. I can't Carnac it and put it up to my head and say, oh, yeah. Again, failure to disclose household members, or if you're doing commercial auto, are they disclosing, if you require it, all the drivers on the policy? Are they telling you where they are garaging the vehicles? Is that an important piece to you? All right, so if you're, mostly Pennsylvania companies here, what's the next state over going east, right? It's New Jersey. Not real good insurance rates there normally. And the worst one of them all probably is New York. So why not take an address here in Pennsylvania? Years ago, we did a case where we had like 250 people living in a 2-room apartment house. Why? Because it became just a place for the mail to filter through. So can you check your database when you enter in a policy and screen just the address to see what else you may have there? Does mail come back to you on delivery? So again, staged events, hard for you to underwrite the policy and prevent this from happening. I understand that, but this is what does happen. And these are all medical claims, just phony medical claims. And they were cheap, which was good. Why? They don't hit that $10,000, authority level for the adjuster. Keep it below, they'll pass it through. But then somebody had to underwrite those policies. Who are these people? Where do they come from? If we do a criminal history background on anybody, it can take 24 to 72 hours, depending on the county in the United States which that criminal history is done. You can get an account with the federal government to do a federal criminal history search at the cost of about 8 cents. Take a look at using the federal government's piece. Now, the problem with the federal government is if you've got a common name, no offense to my friends at Pennsylvania Lumberman's, John Smith, if you have a name like that, there's no date of birth, no social security number associated, so you're stuck. You search Evo Riguzzi, ain't too many of us in this world, you're gonna find them. Again, the perniciousness into the society today of willingness to steal from anybody, and like I said, the federal government. And these guys did it on durable medical goods. Durable medical goods. So we're talking wheelchairs, prosthetic devices, right down to TENS machines. They billed the federal government for it. And I mean, $400 and some odd million. Tremendous amount of money that flows out. So again, my point in showing this to you is that the fraud is there in the system. It's part of your operation. It's the second highest white collar crime in the country. You have to be aware of it. You have to keep your antenna up all the time. These guys don't take a break. They don't take a break. Again, on the underwriting loss control, look to see what's going on in the premises. One of the things that I think is happening today is buildings aren't being used to their full potential. I've got rent to pay. If I can't cut a deal with the landlord, maybe I could sublet. Does that sublet operation then interfere with what you're writing? Could it create for you a higher risk? You got to take a look from that piece. Again, how has your business changed? How will it change tomorrow? Electronic vehicles, charging stations. They're being put out all over the place. Does it affect the risk that you're underwriting? It's just changing what's going on. Yes, last night, I wish it came in too late, but somebody sent me a video of a charging station where the vehicle just bursts into flames. Who knew? You thought everybody thinks it's kind of safe. We always think of gas and gas refueling as a problem. How will your business change in the next 2 to 4 years? And what kind of systems or training or capabilities do you need to add to prevent more fraud from coming to you? Because if you haven't moved to digits yet, you're going to move to digits, and you're going to move to digits even more than you ever have. It's the way we're doing business. We're working from home. We've got to do this by distance learning, distance training, distance working. How do we affect how you do business? And if we do speed and efficiency, do we end up with West Texas? Okay, West Texas. I like this slide because it just shows the devastation of what can happen when you don't know really where you're writing. The piece is not so much that the place down below blew up, and it blew up, and it turned out it was in effect an arson. But the buildings at the top of the slide, which are hard to see, are all residences, and they were all, destroyed. So if you're underwriting those houses, do you know what's going on in the backyard? Do you realize what could be there? This is a slide I took from just from searching the internet, showing where the ammonia nitrate is manufactured or mixed or distributed just in the state of Pennsylvania. The bigger the bulb at the bottom, the greater, in effect, threat to you, because those are the places where they make it. Ammonium nitrate, the Murrah building, Oklahoma City. Anybody remember that? They blew it up using fertilizer, ammonia nitrate. Look at where all these places are. I mean, it's a pretty crowded map. And again, I only did one state for the demonstration purposes, but you should know where those places are. Now, a lot of those places are more than likely nurseries or landscaping facilities where they sell, fertilizer to you, the average consumer. But the ones with the big bulb at the bottom are the places where they actually make it. So, if you're writing in that neighborhood, you should know what's going on. The slide I just showed you that before, those houses were about 600 yards away, and they were destroyed. So.
Come on, Galopus. You're not kidding anybody with that line of bull. You're in the jam and you know it.
Says you. All I want is my money.
There's you. All you're going to get is the cops. Oh, hello, Walter. This is Sam Galopus from Inglewood.
Oh, sure. I know Mr. Galopus. Wrote a policy on his truck. How are you, Mr. Galopus?
I ain't so good. My truck burned down.
Yeah. Now, look, Galopus. Every month, hundreds of claims come to this desk. Some of them are phonies, and I know which ones. How do I know? Because my little man tells me.
What little man?
The little man in here. Every time one of these phonies comes along, he ties knots in my stomach. I can't eat. Yours was one of them, Galopus. That's how I knew your claim was crooked. So what did I do? I sent a tow car over to your garage this afternoon, and they jacked up that burned out truck of yours. And what did they find? They found what was left of a neat pile of shavings.
What shavings?
The ones you soak with kerosene and drop the match on.
Look, mister, I'm just a poor guy. Maybe I made a mistake.
Well, that's one way of putting it.
I ain't feeling so good, Mr. Kid.
Yeah, just a minute. Sign this and you'll feel fine.
Sign what?
It's a waiver on your claim. Right here.
Here?
Here. Now you're an honest man again. Goodbye, Galopus.
But I ain't got no more truck. Honest, it's $100 is a lot of dough where I live.
Smile, Galopers. Don't you know how to open the door? Just put your hand on the knob. Turn it to the left. Now pull it toward you. That's the bars.
Thank you, Mr. Keir.
All right, so that's the movie Double Indemnity. I don't remember exactly how long ago it was made. Anybody ever see it? All right, underwriters, you should take a look at this. It's an underwriting fraud case. They happen to be interjected with a little bit of claim in here. It's an interesting plot. Fred McMurray, my three sons, the good guy, falls in love with a gal and plots to kill her husband and does it. But in the middle of the movie, they come out with this. What's changed? That was yesterday. And it's black and white, right? It's yesterday. It's going on still today. Now, for those who would be in claims, they would love to be able to say, you're a thief, sign the document, get the hell out of my office. It's not, you can't do that, obviously. But this is, again, it shows you how long this has been going on. My other favorite movie is The Fortune Cookie. And again, if you haven't seen it, it's a black and white. Walter Matthau plays an attorney. That film was made in 1964, and it's a workers' comp claim that's witnessed because Jack Lemmon is a cameraman at the Cleveland Browns football game, and he gets run over by some guy by the name of Boom Boom, whatever. And so everybody witnesses the loss. But the deal is that it hasn't changed. Simple stuff. Today, are they a little more sophisticated? Again, they think they are more sophisticated. We think we're as sophisticated as they are. Yes, and once in a while, you get a little surprise. Where did that come from? How was that done? But the methodologies of committing fraud are pretty much the same way. Now, for those, just so you know, as underwriters, there's this law called HIPAA, which you'll notice is titled health insurance. It's not titled property insurance, casualty insurance, workers' comp insurance. The HIPAA Act has acted as a barrier to timely claims adjudication because the clinics will not release the documents without a signed release. And of course, if you're committing fraud, you're not generally inclined to provide a signed release. Fact is, you don't need one. And the law is not applicable to those lines. And this is the government's website. If you're working with your claims folks, just keep that in the back of your mind. If they're saying, I can't get the medical records, I can't determine whether or not this person, how badly they were injured. But it's right there. It's right there in black and white. Does not apply. Doesn't mean you're going to get the records. Our thing to the adjuster is the adjuster has to be able to say to the clinic, you're interfering with the timely and proper adjudication of a claim. That kind of implies liability. And maybe that sometimes gets us the records. Again, Edward G. Robinson used the term, my little man. In other words, that gut feeling. All of you are seasoned. I've seen you around the PAMIC hallways for years. You all have been in the business for a real long time. Don't underestimate your own ability to smell something out, to question it, to at least raise it to the next level, or do a little check. My cards are out here. You can always call my office. I don't charge for it. Call, ask us. Have you guys ever seen this? Have you ever seen this company? We've been in business for well over 20 years. I got a pretty good sized database, especially here in the Northeast corridor. So you look for these things. Look for altered documents. Look for inconsistent information. If you go and check something on an application and it doesn't match what's on the app, why was it said? Don't just say, oh, yeah, okay, he said this. Why did you make that? What made you say this? What made you say that? The power of social media. This can be used. This is a simple example of somebody putting in a claim, claiming they can't do anything. Their back is broken or injured badly. But social media can be used for companies. Do any of you check the websites of the commercial companies to see what they say they're doing? I mean, check and see what they're advertising and then see what's on the application. We've seen many cases like that where they say, oh, no, we don't do that. Oh, we didn't update the website. And then 2 months later, the underwriter called up anonymously and said, hey, can I get X service? Oh, yeah, we do that, which was left off the application. So verify what's out there. Don't, I know we tend to take it, put it in the drawer and move on. You have to go back a little bit later. And remember that they know the 60-day, we call a 60-day, 30-day red flag. Don't file a claim within the first 60 days of buying a policy. Don't do it within the last 30 days because that's the parameter. So believe me, they're very smart. They go to 61st day. I mean, 61st day, I mean, you've got to be dumb. Look at what they're saying. Right, this guy on the left is supposedly fell, injured himself, and has a bad back injury and cannot do work, cannot bend, cannot stoop. This video was obviously not taken by either one of those two people, right? It was taken by somebody else at this rehearsal wedding dinner party and then posted. And the social media, we use a company here in Philadelphia to do our social media searches. And they found this. You doing social media searches, it's all right. Maybe you'll get something off of Facebook right away, which, by the way, usage, if you're following that as a stock, has been dropping off. Basically, Facebook's for old guys like me because I haven't figured out how to get to someplace else. So, but the social media search companies will search. We do an alias search in that process because people use aliases to take out their accounts. And you could be looking all day long and not getting, we don't do it ourselves. It's not cost effective for me to put somebody on that system and then try and bill our hourly rate. And after 2 hours, all we've got is, I don't know what I got. And it does also search Twitter, which is because Twitter is public information. So if you have a special investigation unit in your company, or you have somebody that's designated to do that work, they should be the expert. Although a lot of small companies will just detail somebody else to do that work, but who's ever doing that can't do it without your support. Somebody's got to find those cases. We ask that you report your reasonable suspicions up the chain of command and get it into the state. One, you're being a good corporate citizen if you're reporting it. Some states like New Jersey have information only referrals, which is fine. But if you do a full referral to a state, it should be a complete competent investigation. The worst thing that can happen to you is if you think you really got something hot and you don't organize it and you don't look at all the detail and then send it into the state, because then they're not going to really take the time to look at it either. In a state like New York, it's 25,000 referrals a year. So, how many people do they have to be able to go through them? Again, report your reasonable suspicion. So regardless of the state, all states have a requirement. Nowhere to go. So if you're in any one of these states, these are some of the other responsibilities that have to be taken care of. So if you're writing auto or healthcare in New Jersey, then you need training, an SIU, a fraud manual, and a fraud plan. And then if you hit a certain threshold, you have to file an annual report with the state as well. Auto workers' comp in Pennsylvania, and there's an annual report with the state of Pennsylvania, and that's commercial or personal lines auto. Even if you're licensed to write in Pennsylvania in those lines and you're not writing in the state, you still have to put an annual report in. And then Maryland has any admitted lines. And that covers, I know, the majority of the states. Most of the compliance requirements are in the Northeast. The worst one is California, in the sense it's very, very hard to stay in compliance with there. So if you ever decide to go out there, let me know. Their annual report this year was 42 pages blank. And that's just on the SIU activities. It's not on claims. It's not on underwriting. It's all the stuff that we do. I'll give you some idea. Again, we're experts. If we can help you in any way, please feel free. Again, the call doesn't cost you anything. Ask us to run. We can run your possible insured through our database to see if we've ever had anything. It's not an ISO database. It's not a claims database, so it doesn't get precluded. You can ask us to check out. And if you're writing things like medical facilities, please make sure that they're licensed. Please make sure that they have the coverage, that they're operating within the law. And that includes, we've been able to help knock down fraudulent medical bills by proving that the medical facility didn't file for a specific building permit. Because if they don't have that permit, then they're not operating within the law, and therefore their billing gets negated. We get the bills knocked down and say make them go away. But if we can reduce a $10,000 bill to $5,000, it's a pretty good savings just by checking the building permit file. Do I have any questions? All right. Well, I thank you for your time and attention. And all you have a great rest of the day.
Thank you, Bo. You're welcome. As usual, I do appreciate it. Have a great Thanksgiving. Travel safely. Appreciate it. Okay, so we are a little bit early, so I'm going to try to fill in some of our time so you get your money's worth, or at least you have to listen to me for a little while. So there have been, I'm going to, throughout the presentation, not my presentation, but throughout my responsibilities as sort of hosting today, I'm going to try to throw some tidbits of information. So for you folks, most of you here are Pennsylvania domestics. You've dealt with the insurance department for many years. However, there is a changing face of the insurance department now, and I want to share that with you. So in the recent months, starting in September, actually two of my former bureau directors have retired. So you folks may remember Chris Monahan. He was the deputy for market regulation, which is the position I had before I retired. And he retired in September of this year. He had over 30 years experience at the department, so a great loss of experience to the department. And it's not unusual. I mean, there's the department's aging as well. I was just at a meeting with some legislators, and they shared that the insurance department has now said that almost 2/3 of their department will be retirement eligible, 2/3 now in 2 years. Okay, so my guess is we're going to see a lot of people changing positions there. Probably the person you're most familiar with at the department that just announced her retirement and will be effective at the end of this month is Carolyn Morris. She was the director for consumer services. So they're the folks that would would hand you all the complaints that came into the department, and then you would have to respond. And Carolyn has been a good friend of mine. She actually started at the insurance department in 1988. And we worked together starting in 2000. I was the deputy and she was the thing. So I've known her forever, and she's a wonderful person, and I hope she enjoys her retirement. But the reason why I share that with you is because obviously they're going to be replaced with new folks. Chris Monahan was replaced with a gentleman named David Buono. David came on in the insurance department in the early part of the Wolf administration with the title of consumer liaison. And now then he served additionally as a special advisor to Commissioner Altman. And now he's been placed in the role as the deputy for market regulation. Carolyn's position, they have not officially announced a replacement for at this point. So I've heard rumors, but I don't think I should be spreading those rumors now, but it's somebody that's been with that operation for a while. So hopefully it won't be a new person for you folks that have to deal with that kind of information. All right, so with that, I think are scheduled, right, Britt, for another break? Okay, so we can go a little bit longer. We'll just keep on schedule here. So let's meet up once again at about 11 o'clock. And then I get to introduce a very good friend of mine as well, Rick Hartman. Rick, I don't even, is he back there? No, he's not back there right now. He's practicing. That's what's going on. So anyway, take your break, come back about 11 o'clock, and we'll restart our seminar. Thank you.
I forgot to mention we have laminated
So for those folks at home, Evo just said that he has some takeaways that are available here. And if you don't mind, we'll take some with us. And if anybody that's on with us virtually, we can send it to you as well. So thank you.
Awesome. Gotta come here.
Okay. Were you with them? Sorry, were you with them?
I was with ARI, American Alliance.
Oh.
5 years.
ARI, that
Karen-
was a
Karen
mutual-
Fulton,
yeah.
Karen Fulton was, I think she was part of this.
well, they were at one time,
Yeah.
but then they got bought out by somebody, right?
AmTrust.
Yes, right.
Yeah, she wanted to retire, so she sold to AmTrust, and then they closed our office, which is why I went
Yeah.
to PLM. But they were very involved in
Yeah.
Panic. You know, she was for many, many years.
Right.
Because it was a mutual way back when.
Cast, yeah. No. Rick, are you getting anxious to start? You know, you're the guy just before lunch, so. That means you can't go late.
That's it. I never, if you give me an hour, I got 40 minutes.
Thanks.
45 minutes, I got 30.
So now you got an hour, right? Exactly.
Oh, yeah. 45 minutes content, we got questions, great.
If you don't mind starting to get your seats, I'd appreciate it. We're going to start just on time here, and I'm also going to make sure the folks out in the hallway get there. So if you don't mind finding your seats, thanks. And you're talking about ESG, well, you're social inflation, but ESG is part of that. Okay. Yes. Okay, so I actually get to introduce a young, talented man, Rick Hartman, from now Guy Carpenter, but I knew him in a former life when he was at that other company that he can tell you who it was if he wants to. But Rick, I got to tell you, as a young person, he really dove into our industry, really stepped up to the plate numerous times. We won't talk about his hypnosis skills at all, but if you do get to sit with him at lunch, ask him about his experience being hypnotized. It was fantastic. With that said, his presentation is going to deal with social inflation. And this is a big topic within our industry. And in fact, in the insurance industry in general, PAMIC is putting on a webinar, which we don't monetize for any of our members or contacts, on what we call ESG, environmental, social, and governance related issues. And it's the next new topic, especially for corporate governance kind of folks and leadership in companies. So if you have a chance, go to our website, see if it interests you, and hopefully your presentation will be a great little tease, at least on one part of that seminar as well. So without me going into his resume, if he wants to talk about how great he is, because he is a great guy, Rick can do that. But Rick, the floor is all yours.
Thanks, Ron. Appreciate it. Microphone on? Can you hear me okay? Okay, great. Well, so I'm Rick Hartman. For those that don't know me, I'm a treaty broker at Guy Carpenter's Philadelphia office. Ironically, I actually started my career as a property facultative underwriter. I spent about just over 10 years with Gen Re before moving over to Guy Carpenter. And I got to Guy Carpenter and said, "Oh my God, you worked at Gen Re. Well, you must be a casualty expert." So I was too afraid to say no. So now I found myself leading some large MGA umbrella excess liability quota shares, working closely with our casualty group captives, and have kind of morphed from property underwriter to now, both a multi-line treaty broker, property cat treaty broker, as well as some specialties in casualty excess of loss, casualty umbrellas. But I'm really excited to be back here at PAMIC, and I'm really excited to be back here at Hershey in particular, because the first conference I ever attended to, maybe a year or two out of college, was a PAMIC event. I think it was the PAMIC annual conference, and it was at Hershey. And I showed up at the hotel registration desk, and unbeknownst to me, when you register for a conference online, that automatically doesn't mean you get a room reservation. So unfortunately, the hotel did not have a reservation in my name, despite multiple spellings of it. And then I asked, so you're probably full as well? And they said, yes, we're totally booked. That's when I had a petrified look on my face, and I turned to my former colleague, John Stone, like a puppy dog saying, can you adopt me, please? John was kind enough for one night to let me join him. And I remember him putting the key card in and thinking, dear Lord, please let there be 2 beds. But for me, yes, and head to toe, John. And Shark Week was on too, so we lucked out. But if you Googled social inflation, you would see a number of definitions. For me, social inflation, broadly defined, just represents the ways in which insurers' claims costs are rising over and above economic inflation. So today, I want to start out by just level setting everyone in terms of establishing a baseline of where the insurance industry is today as respects to the impact of social inflation. Then we'll take a little bit of deeper dive into some of the macro level trends and drivers within the commercial auto liability space, as well as the excess and umbrella space. We'll target some of the dynamics that are impacting the casualty reinsurance marketplace as well, and just a handful of maybe risk management strategies for our insurance carriers to think about. So in looking for ways or trying to find ways to better understand what concerns insurance carriers have or what insurance concerns they're facing, we have an algorithm or a model called Alpha Source, which helps us track keywords across investor earnings calls through a cohort of about 39 publicly traded insurance companies. And through that, as you can see in the dark blue bar here, pricing was the #1 topic in the Q3 earnings calls, followed by ESG as well as social inflation with 14.1% of the overall mentions. So an increasing number of carriers are really expressing concern around the need for rate and increase rate in order to combat the heightened natural catastrophe loss activity. Think Hurricane Ida, Winter Storm Uri, the European floods, as well as some of the underlying economic and social inflation trends. Oh, a little reverb there. Thank you. Next, just taking a little bit more of a focused approach, we disaggregate that data and look at the individual carriers and their individual concerns. So the dark orange bars represent the number of social inflation mentioned. So as you can see, despite the reinsurance and insurance industry maintaining significant levels of capital and liquidity, there's real concern about the threat of inflation and the impact of social inflation on both reserves and underwriting performance. When it comes to pricing, so here we have a casualty of Marsh US clients tracking quarterly rate change starting back in 2012. So I understand that Marsh clients, the Marsh universe of clients, maybe doesn't necessarily align with that of mutual company carriers. However, I do think that it's just an additional data point, additional observations around the trends, macro level trends, pricing trends that are driving the insurance industry. So what you'll see is that from a casualty composite perspective, and that includes general liability, auto liability, workers' compensation, we started to see a steady rise in rates in the first quarter of 2019. Most recently, in the third quarter of 2021, we can see a 6.5% increase. However, if we strip out workers' compensation, which we know has been in a period of rate softening, the actual rate change for general liability, auto liability is about 10%. So social inflation really isn't a new phenomenon. It's a trend that's been around and made appearances in the 1980s, in the late 1990s, and in the 2000s. The challenge really, though, is in terms of identifying and quantifying the impact of social inflation, as some of the metrics that we use to track social inflation can be really inconsistent over long time horizons. However, our teams identified 3 key variables or 3 key drivers of social inflation. The first being the wealth gap index and sentiments towards big business. The second being legal ad spending. And then the third being third-party litigation funding. So what am I saying when it comes to wealth gap index? Really, the wealth gap index is an indicator of social unrest and disparity. Meanwhile, the sentiments towards big business represents distrust of corporations. So you'll notice a spike in 2001 and 2002, that light blue line on the wealth gap index, and that's a direct response to the WorldCom and Enron scandals. Next, if we look at legal ad spending, or we think about legal ad spending, you drive down the highway, you see the big billboards, you come across the advertisements on your phones or TV commercials. We've all seen these ads. Law firms are increasing their advertising on social media, and they're advertising larger jury awards as well. In fact, over the most recent 5-year period, we've seen a 9% compound annual growth rate of legal spending. Well, what does that mean? As law firms are spending more, they want to see a return on that investment. Therefore, they're driving more civil lawsuits and higher litigation costs. Lastly, third-party litigation. Third-party litigation is a relatively newer trend that's impacting the sector, and that refers to third parties that are agreeing to either pay all or part of the costs or expense associated with pursuing litigation or pursuing arbitration. So they'll reimburse you for the costs associated with pursuing litigation or arbitration. So what's that doing is that means more cases are going to trial, and as a result, we're seeing more verdicts. And two, I'm totally conversational if you can't tell. So if there's questions along the way, please interrupt me. I know I'm before the lunch slot, so I probably have about 45 minutes of content. So we can either do Q&A at the end, Q&A as we go along, or we'll just break early for lunch. But on top of all the dynamics that the insurance industry has had to deal with, the closing of the courts really added an additional dimension of uncertainty. So just focus on this red dotted line here, and that tracks the median verdict. So prior to the pandemic, what we saw is an increasing number, not only in the amount of verdicts, but also in the compensatory awards or the verdict size. Then in 2020 and 2021, when the pandemic hits and the courts were closed, that median verdict size naturally dropped off. However, what insurance carriers are really concerned about as the courts reopen and claims start slowly moving through the system, what happens if inflation or social inflation begins to heat up and tick up? Therefore, they're being a little bit more proactive in terms of managing their reserve adequacy or booking current rate change. We saw earlier the rate change as IBNR. On the first slide, right, we talked about a couple of the key concerns that we were tracking from investor calls. We mentioned the firming pricing, large losses, ESG, social inflation, but another component in there beyond cyber and other inflation was favorable and unfavorable reserve development. So what we're seeing is that the industry is still, really in a strong capital position, highly liquid, and reserve releases are still ample. In fact, if you look at where we are year-to-date 2021 in terms of reserve releases, we've had more favorable development through 9 months of 2021 than year-end 2020 and year-end 2019. So really that favorable reserve development is being driven by the workers' compensation and short tail lines of business. But again, insurers are still very cautious because if there's persistent underlying social inflation trends, you can really have not only underpricing, but you can also have under reserving. Okay. So next, I just want to touch on kind of two macro indicators used to identify commercial auto liability trends. The first being miles driven, and the second being used vehicle CPI. Now, as respects to miles driven, what we saw in 2021 is that miles driven increased year over year 12% compared to year-end 2020, but still lagged behind the pre-pandemic levels seen in 2019 by 4%. Now, miles driven tends to have a really strong correlation with claims frequency. More miles driven, more claim frequency. So as we return to kind of pre-pandemic levels, will that claim frequency, that elevated claims frequency continue? From a loss severity perspective, we really saw a spike this year in loss severity due to supply chain issues and chip shortages, which drove up the cost of used cars or repair costs as well. So if you were lucky enough to sell a used car, great. But if you had to go buy a new car, you're paying over sticker price. And so this chart is a little bit complicated, but we'll walk through it step by step. Just wanted to, when we're talking about social inflation, ask to try to identify the impact on commercial auto liability as well as umbrella. Wanted to just provide a snapshot of the historical profitability and performance of the commercial auto line of business. Now, the light blue columns represent rate change. The dark blue line represents accident year net combined ratios, which we think is a really good indicator of loss costs and if we're adequately pricing the exposure assumed. Now, what you'll notice is that industry accident years have been well in excess of 100%, peaking at 2016. As a result, we've started to see insurance carriers take a tremendous amount of rate change, 7%, 7%, 9%, 10%. So after those accident year results peaked in 2016, we've seen those results drop by 15% in the last 4 years. Next, just wanted to provide two different views of performance, both from a direct written premium standpoint on the left-hand side, taking a 5-year average of commercial auto liability direct written premium growth, and then on the right-hand side, a visualization of the 3-year average loss ratio by state. So what you'll notice is two things. So first, on the left-hand side, direct written premium growth, you would expect that's going to track with population growth or demographics, right? So where's everybody going to right now? Places warmer, Florida and the Southwest. So that's why you'll see the states with the highest growth rates, Florida there at 12%, Texas 11%, and then the Southwest also in double digits. Compared to the maybe the PAMIC Mid-Atlantic footprints, you have Pennsylvania, Maryland, New Jersey, kind of all mild, tempered, moderate single-digit increases in direct written premium growth over that 5-year period. On the right-hand side here, we track the 3-year average direct loss ratios. So we all know as a former underwriter myself, but new business runs at higher loss ratios. So it's probably no coincidence that the state with the highest levels of premium growth are also the states or regions that are experiencing deterioration in results or loss ratios that are well in excess of the industry average. For example, Florida and the Southwest are all states that have loss ratios, 3-year average loss ratios in excess of the industry average, compared to the Mid-Atlantic footprint, Pennsylvania, Maryland, New Jersey, again, that kind of saw mild tempered growth, have loss ratios that are below the industry average or outperforming the industry average. So shifting gears, just wanted to spend a little bit of time talking about some of the profitability rate trends impacting the excess and umbrella markets. So here, the red line is tracking rate change, average rates change by quarter from CAIB. And then the dark blue columns represents average rate change by quarter from our Marsh composite of companies. So again, you can see that our Marsh composite of companies actually tracks fairly well with the CIAB. Now, even though you can see that red line started to take a slight dip, so even though that we're seeing a slight reduction in excess and umbrella rates, they're still at elevated levels, plus 20% in some cases. Furthermore, the attachment point requirements have changed. So most umbrella excess liability underwriters are now requiring a $2 million attachment point for commercial auto liability. That's driving a need for buffer layers. We're seeing a tremendous amount of buffer layer requests. And I say buffer layer, I mean the 1x of 1. So both on a facultative basis as well as a treaty basis, because of the umbrella market requiring those higher attachments, those higher retentions for the commercial auto liability line of business. Why are they requesting higher attachment points? Well, we saw earlier this increasing claims frequency, increased loss severity, unprofitable results, prior year reserve development, adverse reserve development. So taking a look at the historical profitability and performance of the other liability line of business, which is where umbrella is captured in the annual statement, as well as product liability. What we can see is that the accident year net combined ratio show there in the blue line started to really spike around 2016 to 2019. And that's when the industry responded by doing two things. One, taking a tremendous amount of rate, and two, starting to look at how they were managing their limits. So you can see in the most recent accident years here, the dark blue lines represent the amount of excess rate change. So we saw, anywhere from +20 to +25% as an ability to try to combat deteriorating performance. Secondly, from a limits management perspective, you used to see a lot of insurance carriers out there. They were writing lead $10 million umbrella policies, lead $15 million umbrella policies, and they would cut back their capacity. So instead of a lead 10, they're now doing a lead 5. Instead of a lead 15, they're doing a lead 5. And as a result, that created not only capacity shortages in various towers, but it also required a need for excess capacity in both the traditional and reinsurance marketplace. At Guy Carpenter, we really have the unique ability to aggregate data and analyze data sets. And when it comes to umbrella loss ratios and advocating for the biggest conversation with reinsurers is, loss trend, severity trend, industry trend picks, because we look at historical experience, we on-level the premium, we trend and develop historical losses, we get a loss ratio, we project that loss ratio going forward. But is that truly accurate and reflective of underlying market conditions, underlying trends? So we're starting to take a deeper dive in terms of the core inflation variables, as well as the impact of social inflation variables, to really get an understanding of what an accurate reflection of loss trend is. We have over 4.4 billion of umbrella and excess liability data that we analyze. Here, we're just looking at lead umbrella, so that's attaching excess of the primary. And in this first box on the left-hand side, you can see, right, that we had a really big divergence in terms of loss ratio and earlier in the decade, deteriorating umbrella losses. And what we saw on the slide before, we started to see tremendous amounts of recent rate change. And what that's doing is it's helping to stabilize the loss ratios. As you can see, the projected loss ratios going forward here in this gray box, our median picks somewhere around a 55 to a 60. And the average attachment point can range anywhere from 500,000 to 2.5 million. But again, most of the composites still staying at $1 million attachment point. So loss ratios appear to have started to stabilize in recent years as a result of significant industry rate change. So what is the right amount of trend? And I think that's the biggest question. So looking at yearly change in industry results relative to achieve rate change provides really an indication of the appropriate excess loss trend. So when you look at individual years, you can see a tremendous amount of variation, which is why actuaries all love to take, kind of a multi-year approach, whether it's a recent 5-year or an average of 10 years. Sometimes the more recent view is more indicative of the go-forward projection, right? There may be more credibility in the result. But overall, what we're seeing within the portfolio, again, that's 2.3 billion of aggregate data, is that lead umbrella loss trends have been, in the 5 to 7% range. I can tell you that's maybe from a reinsurance broker perspective, and reinsurers in the room would likely maybe disagree with that trend. We've seen cases where reinsurers are advocating for 8, 9, 10% loss trend. So we've talked about some of the carrier concerns, social inflation, ESG, firming market pricing. We've talked about the rate change, rate increases across auto liability, general liability on the primary space. We talked about double-digit 20% excess liability, umbrella rate change. What's happening in the what's happening in the casualty reinsurance marketplace? So the dark green bars represent rate change at the mid-year renewals for loss-impacted accounts. Those are accounts that had significant loss. And the light green bars represent non-loss impacted accounts by line of business. In general, capacity was very stable for the sector outside of really 2 lines of business, excess liability and umbrella business, as well as clash covers. There we saw kind of capacity shrink a little bit and rate increases, anywhere from +20 to +40%. But generally speaking, for non-loss impacted casualty excess of loss accounts that you would see in a mutual company, multi-line tower, or working cover program, rate increases average anywhere from kind of 5 to 15%. Workers' compensation, non-loss impacted accounts, still seeing a reduction in there, much like what we were seeing on the primary space. Been consistent profitability of both calendar and accident year results, really a strong appetite of reinsurers for that business. So just wanted to maybe discuss a few risk management strategies for the group in terms of dealing with some of the factors that we're facing today. So for mutual insurance companies, predictive reserve development and positive net investment yield are critical for stability and growth. So one, we're in an extremely low interest rate environment, which is dragging down investment yields. But two, we're coming out of this very long, low inflationary environment, and inflation risk is a very real concern. So insurance companies and risk managers are trying to hedge against inflation risk and other adverse development risks, such as litigation increases or regulatory risk, and exploring retrospective reinsurance solutions or legacy liability solutions. Those can include adverse development covers, loss portfolio transfers, or novations, but effectively you're transferring your company reserves, usually at a discount, to a reinsurer. And in exchange, that's freeing up your capital to take advantage of current market conditions. So what are some of the benefits, or what are some of the driving motivations behind exploring a legacy liability solution? So we talk a little bit about capital management, but also releasing or freeing up capital. So instead of an insurance company or a risk manager allocating capital to prior year reserve development or back year underwriting support, you can free up that capital to take advantage of current market conditions, current pricing conditions. Provides more certainty of results, facilitate an exit from a line of business. So by transferring the servicing of claims to a reinsurer, an insurance company is able to save time and expense associated with servicing a discontinued line of business. Lastly, facilitating M&A transactions. So we've certainly seen an uptick in M&A transactions as a part of capital growth strategies, inorganic growth strategies. So in terms of getting a risk manager or an insurance carrier comfortable with the reserve performance of an acquiring company, they can look at a retrospective reinsurance solution. Next, just wanted to share an update in terms of the legacy market, right? That's really synonymous terms, legacy market, retrospective market. In the past, it was really viewed as a market of last resort, almost like a dirty word. But now it's viewed as a tool for capital relief. So what you have here is you have a significant amount of excess capital coming from the private equity markets flooding the legacy liability space. What that's doing is it's putting pressure on those markets to deploy that capital rather, which is increasing the competitiveness and driving more attractive terms for the buyer. Next, you have this shifted paradigm. So again, they used to be more focused on, and they being legacy markets, more focused on finality solutions, but now they've kind of transformed into providing capital relief, helping companies release capital through solutions like an adverse development cover or innovations. Increased seller motivation. So we talked earlier about some of these underlying concerns of persistent social inflation, economic inflation, medical cost inflation. So as a hedge against that uncertainty, buyers are more motivated to maybe transfer the responsibility of those reserves, of the claim servicing, to another reinsurer. And then lastly, improving market reputation. Again, it used to be the market of last resort, and now, now there's a lot of high quality companies in the space, and it's known for a tool for capital relief. So we've really seen an uptick. I think this year, maybe about anywhere from 65 to 70 legacy market transactions. And then lastly, this will be my last slide. So if there's any questions, now would be a good time to think of them. But I don't mean for this to sound as an infomercial by any means, but I think I have to put in like one obligatory Guy Carpenter slide here. But if you're a mutual insurance company and you're trying to think of ways to maybe manage your umbrella portfolio, we have a dedicated regional facility that's been established since 1974. I think the biggest driver for a company that would explore a facility type solution is you always worry about, well, I want my book of business. It's unique to me. My experience is unique to me. Yes, absolutely. And it's priced that way with very competitive terms. But in the event of a loss, rather than having a reactionary conversation the next year requiring a rate increase, that company loss is kind of socialized across an entire portfolio of companies. We've got 6 or 7 dedicated markets supporting it that are all A-rated or better. We're able to provide some direct underwriting support, both through the lead reinsurer as well as some of our capabilities. So again, it can be a challenge for insurance companies, mutual insurance companies in particular, looking at umbrella or excess of loss reinsurance solutions because of the premium to limit balance issue, right? Oftentimes, there's not enough premium in umbrella policies because of minimums or low net per million pricing to attract reinsurers. They're putting out more capital. There's more risk than really premium that they're assuming. So this can be an affordable or cost-effective solution for a mutual company looking for coverage. So Ron, I hope you don't kill me that I'm a little bit early, but if you have questions, I don't know. I know Brittany was going to mention questions in the on the Zoom chat. Otherwise, I always think it's better to be early for lunch as opposed to late.
Well, if there's no questions for Rick, I guess we can take a break. But Rick, thank you once again for your presentation. I do appreciate it. It looks like you're going to get a little bit longer lunchtime than we had originally planned. I hope you're not too upset about that. Okay, I don't see anybody saying they're really upset. Rick is done now. So thank you, Rick, very much for your presentation. I appreciate it.
No question. No.
And, why don't you take the opportunity now, catch up with emails, phone calls, texts, whatever you have. And then lunch is going to be served in the room right behind us. And I do know that they already have the tables set with at least salads and desserts. What more does anybody need, right? Salads and desserts. Anyway, thank you very much. And for you folks at home, we'll be joining you again at about 1 o'clock. So thank you.